Well, good day, all. Ira Epstein, and here we are with your financial market wrap-up. And this wrap-up is for Wednesday, the 15th of February, 2023, about 6:20 p.m. Central Time. You know, this is a tale of two markets. Let me explain. The first market is the strength the U.S. dollar is getting off the ideas that the Fed is going to raise interest rates longer, in other words, more, and keep them up there longer. That's the right way to say it. At the same time, you're already seeing banks caving in like the Bank of England. Maybe we can't go any further, blah, blah, blah. And a lot of foreign currencies falling against the dollar. Well, as that's taking place, you've got to remember, American goods and a lot of commodities that aren't American, energy market, example, not all the oil in the world is ours, goods that are sold abroad, they're priced in dollars. I mean, if even gold, think about it. The gold market is priced universally in U.S. dollars. That's how you originally buy it. I don't care how it's resold within the country, but to import it, it's typically U.S. dollars. That makes the goods, as the dollar goes relatively stronger, higher. Now, I went in and I was looking today because I want to do a special report and I'm having trouble putting one together. What market do I hone in on? And I keep looking at the markets and going, okay, I saw today Roku did better, stock up nicely after market, Cisco, different markets. And then it's dawning on me, okay, those are names. Roku's probably more domestic, but Cisco's all over the world. So I looked at the dollar. You know, the dollar's in the bottom part of where it was in the fourth quarter of last year. It's not like it's surging. It's coming back up. It was much lower. How is that going to hurt the first quarter earnings abroad? I don't think it can. So the stock market, I think, is saying, okay, it's looking at that. It's looking at the fact that for whatever reason, stock traders believe in a major way that the Fed isn't going to follow through on its deal. And as strong as the economy gets, that strength means that the weakness is going to be very short-lived, if at all. Remember, Wells Fargo's already saying, I heard him, one of their analysts, that they think the bear market is already over. Now, that's not the case with Morgan Stanley and some of the other firms. They're the exact opposite, warning traders, you've got to be careful here. Got to be very careful because this market is not priced in a recession that can really upend things. Which side of the equation's right? Here's what I know. I write a twice daily newsletter. Today's newsletter was on the money. I'm looking at the market, and I started writing at about 10 this morning, and I'm going, you know, each break like we were having, and at that point, the markets were down pretty good. I said, if you look, we're approaching the 18-day average on everything, coming down to it. If I'm right, it's going to do what it's been doing consistently, finding support against it and trying to turn higher. And by golly, that's exactly what happened at day's end. Didn't happen in the gold. These markets got hit. It didn't happen in notes and bonds. If you're watching, they're taking off on the yield. Your 2-10-year touching near 90 at points. Okay, you're getting up there. Grain markets got hit pretty good today. Fear of the strong dollar. It's the stock market all by itself. So when we look at the S&P, this is a weekly chart of closes. You're up 1.5% for the week. Yeah, that's a neat little gain any way you want to cut it. Ever since it got back over the red 18-week average of closes, this market has stayed with a very good bid. When we look at the macro mini S&P 500, as I told you, we seem to be caught between this high and that low, and you're spinning your wheels. I call this a consolidation pattern. If we look at the pattern right now tonight, just as I'm doing this, the market is up to 41.64. So if we step back, the highs, I can't do that. I thought I could. You've already taken out the highs of yesterday. So this red arrow pointing down is not going to go up. It's going to go higher, low, higher, high, putting you back in an uptrend until you take out 41.13. But this is what I was writing about. I'm watching the market each day fall back to that average, and it's not in a trend until just now, as I said that, with a pattern of a higher high, lower low, which to me is untradeable. But I respect that markets go back to that 18-day average to find its major support. And that keeps the bias up. When a market's over that number, the bias is up, so you're looking for events that kick in. I think you're getting one part of that tonight with the market making a higher high. And as I said, the risks are big. I mean, to risk back under 41.13 when you're at 41.62, 40 points. On a full-size contract, that's $2,000. That's a bit of money. When we take a look at momentum, the momentum of the market is overbought. So for my type of chart analysis, the risk reward isn't there. That doesn't mean that the trade doesn't go on. It means it goes on without someone like me. When we come to the NASDAQ, we didn't quite make our run to this average. You can see that. Not there on this particular one. The last rally high here was what was that, 128.10, and now we're pushing here at 127.70. So the market's trying to come back up to those old highs, still a higher high, lower and low. You did go back down in the Dow. You failed to break through on the Dow 2 days ago. Came back down today, and now we're already into the trade for Thursday. And look at how you keep narrowing in that Bollinger Band. It'll narrow into the point where it won't stay narrow anymore, and it's going to explode out of it one way or the other. Is it giving me a signal which way? Not on the daily chart. And in the Russell, how many days have you come down to the 18-day average to find your support? So that was my argument. I then also pointed out that the VIX was dropping. As the market was breaking this morning in stocks, the VIX was dropping. The two don't rarely go together. And I said, there's something not right with that. There's something very wrong. And as it worked out, the support at the 18-day average held. When we come to the T-bond market, lower highs, lower lows. So the long end of the market is now again doing what I said. You might be going back to this level. Don't be surprised. The market doesn't believe the Fed. The market isn't right in that terms. The Fed is watching all this. The Fed has to be looking at the CPI. Tomorrow we get the PPI report. If we keep seeing this type of strength, there is going to be a problem because all that keeps happening is the Fed says this market hasn't slowed down. We've got to keep doing what we have to do here. Retail sales today showed, again, a blip. A nice blip. I think it was one of the better numbers in 2 years, right? The investors strong, they're buying. It's like the Fed doesn't exist at 5% rates. Pretty interesting as to what's going on. 10-year note, same thing, embedded reading. So do I like to sell the first break under a 100-day average? I hate it, but the market is almost screaming. That's what you got to do with stops over that other high if you get the bounces in the market. Until you lose the embedded reading, it's going to stay bearish. The dollar, very difficult trade. Again, market's now trying to embed, The market came down, found itself at the 18-day average yesterday of support, follows through today, gets up, but it's not a trend yet. You don't have any trend at all in it. And in the euro, you don't have a trend. You got a higher high, lower low, and you're trying to develop a bearish embedded reading here. A difficult time. And sometimes that happens. Sometimes you close your computer screen, you walk away. My setups aren't there. I'm in that camp. In the British pound, we should see first support now at the 200-day moving average in the British pound. They can talk all the toughness they want. If they don't raise rates there, their inflation's taking over. They got a real problem. And the pound will fall out of favor very quickly on that. They've got to keep that going. I feel like $1 million in my Bitcoin call. Down here, I said, I think the pros are coming out. Up here, no. I don't think the pros are jumping in and buying. Now, the SEC is also making a change. I don't know if you're aware of it. They're discussing, when you make a trade, it used to be T plus 3, then T plus 2. Trade date plus 2 to meet your money, get your money into your brokerage firm. Otherwise, you got to come out of your trade. Well, because of the meme people that drove up stocks last year, they want to go to almost instant cash. And there's a move underway. I think it's going to be trade date 1, but they could go to trade date, which means, yeah, you have margin in your account. You can do whatever you want as long as you're margined by the end of the day. So I don't care whatever margin you're working with, you're going to have to be able to pay for that stock. Whoa, that changes the game. That takes away a lot of these traders. It makes them day traders. They won't be position traders. In Brent versus WTI crude, the U.S. is shipping more and more oil abroad. We have become, again, a pretty good exporter of our oil. Pay attention to that. But you'll notice that instead of the market being here at $6.50 instead of near the $4 level, it's up here, which means the Brent is still relatively a better buy. What does it mean? Not a better financial buy, but a tighter market worldwide. And that's why the differential between the two. Where are we fighting a battle? Tell me that you don't see that 18-day average, that red line. And you're right on top as well of the green line, which is the 84.94, the 100-day average. Just right there. Market's looking for a direction right now. Will it find it? Well, won't take much. If you take out the highs of today, Wednesday, you get your initial buy. WTI, same thing. If you can take out this high, you then set up higher and lows. You got the higher high already. That could set that up. And in gasoline, any move now over 273.03 certainly looks like it coming out away from the 18-day and the 200-day moving average resistance. Trend down. It's looking for the bias up. It's close. It's not there yet. Natural gas, I don't think it has to go much higher. It's made its run at the 18-day average. You might want to stall here a bit. That would not surprise me in any way. Now, if you want to learn more, we've put this together for you in what we call our trading kit. Now, the trading kit's got our charting software in it. You can get access to all of our research reports, our market letters. You can get access to all the brochures that we have, the courses from the Chicago Mercantile Exchange, 2 of my free charting courses, the Arun Indicator, along with working with pivot points. I think you'll find it fascinating. 14 very common chart patterns that you should keep on your desk, keep them understood, where you're at with it. You put this together and away you go. Now here's something you don't have. It's the cause and effect PDF download. And when you open it, you start understanding M1, M2, and M3, the money supply, and you have to understand it in these markets. This is what the Fed is talking about now. You've got to understand the velocity of money moving through the economy. So how do you get any of this? Well, it's pretty simple. All you do is go to our website for free offers. You can move your cursor up to the top here. An icon will appear. You can get it or call my staff. It's worth having. Take a look at it. I'm Ira Epstein. I'll talk to you all tomorrow. Take care.